Welcome students to another lecture in the series. Let us continue and practice certain questions from the head income from house property. Let us practice certain numerical questions in this lecture. Let's begin because we are almost done with the provisions now. Let us check out that whether we are able to solve the questions or not. Mr. M took a loan as on 1st of April 2011 of rupees 1 lakh at the rate 12% per annum for the construction of a house. She repaid the entire loan on 31st of March 2013. Construction of the house was completed on 1st of January 2015. So we need to compute the deduction of interest for the assessment year ending 31st of March 2016. Let us see the solution. See, deduction of interest will start from the previous year, 1st of April 2014 to 31st March 2015. Interest for the pre-construction period basically here. So the period from the date of borrowing till the date of repayment, that is your 1st of April 2011 to 31st of March 2013, that has been given here. It is a period of 2 years, we can notice. So we can just charge 12% of rupees 1 lakh, which will come out as 12%, sorry, 12,000. So it is a period of 2 years, so 12,000 into 2, rupees 24,000. Then we know very well that we are allowed to carry it forward for 5 years, so 1/5 will be allowed in this particular year. So we can just divide it by 5 and obtain 4,800 as the amount and solve it further. Now let us see this question. Mr. A owns 2 houses. The expected rent of the house is rupees 65,000. This house was let out for rupees 7,500 per month, but the rent for the month of February and March 2014 could not be realized. So there is unrealized rent in this case. The expected rent of another house is 1,50,000. This house was let out for rupees 12,000 per month, but the rent for the last 3 months could not be realized. In both these cases, Mr. A fulfills the condition of Rule 4, so we are required to compute the gross annual value of both the houses. So we will consider here expected rent of house 1 is 65,000. For house 2, it is 1,50,000, which is given here to us. Annual rent will be considered as 90,000. Why? Because it is 7,500 per month, and here in this case it is 12,000 per month. So 12,000 into 12, it is 1,44,000. In the first case, for house 1, the unrealized rent is 15,000, whereas for the house 2, it is 36,000, because they are saying the rent for the last 3 months could not be realized. And in this case, the rent of 2 months, that is February and March 2014, was not realized, so 7,500 into 2. Actual rent after deducting the unrealized rent, we know very well here is 75,000, and here in this case it is not applicable. Then in that case you are able to obtain the gross value as 75,000 and here as 1,50,000. What has happened in respect of your house 2, the expected rent is already higher than the actual rent for the whole year before deducting the unrealized rent. So for that purpose, the expected rent will be taken as the amount here. Now let us have a look to another question. This is a full-fledged question. Mr. A is the owner of these 4 houses, house 1, 2, 3 and 4. So these particulars are given to us. We are having standard rent, municipal valuation, actual rent, municipal taxes, annual charges, interest on borrowed capital, repairs and collection charges, then fire premium, ground rent. There are more, I suppose. Let us see on the next page. They are saying that house 1 is a self-occupied house. House 2 is let out for residential purpose for the whole year. House 3 is let out for business for the whole year. House 4 is 3/4 used for the own business and 1/4 let out to manager of that particular business. So we need to calculate proportionately in such cases. So we need to find the income of Mr. A from house property for the assessment year 15-16. Assessment year 15-16, this means previous year 14-15, we need to work out the solution. Let us have a look to house 1 first of all, because it is a self-occupied house. So in that case, because for the whole year it was self-occupied, so its annual value will be deemed to be as nil. Very simple, we can subtract the interest on borrowed capital, that is 80,000 from us, and we are able to obtain the loss from house property 80,000, which we can set forward from among the income that he is having from the other houses. Okay, Let us have a look to the house 2 now, which is let out for residential purpose for the whole year. In this case, the expected rent would be considered as 5 lakh rupees, because we need to consider the higher of market value or your fair value, whichever is like subject to your standard rent, means it cannot go beyond your standard rent. Then we can have our gross annual value, because this is higher of the expected rent or actual rent. Actual rent is more, so we will consider it as 6,80,000. The next step is that to subtract the municipal taxes from it and obtain the net annual value from gross annual value. Then we know very well there is a reduction, standard deduction of 30% from the annual value. So we will calculate 30% of 6,50,000, which will come as 1,95,000. So we will subtract, and then they have mentioned that there is interest on borrowed capital in case of house 2. So we can subtract that amount of 1 lakh from it, and we can obtain the income from house property as 3,55,000. Then in case of house 3, the gross annual value higher of municipal valuation or actual rent is rupees 20 lakh less the municipal taxes of 1 lakh rupees, and we can obtain the net annual value of 19 lakh rupees. And from there also we will calculate 30% of 19 lakh, that is 5 lakh 70,000. We will subtract this as standard deduction, and we can obtain the income from house property, that is 13 lakh 30,000. Then further, in case of house 4, because this house is used for own self own business, and the income from this is not taxable under the head income from house property, but under profits and gains of business and profession. So therefore 1/4 of the portion of the house which is let out to the manager is assumed to be incidental to the business, and hence we are not assessing it under the head income from house property. So in that case, the total income that he is having from house property, Mr. A, is, because from house 1 it is nil, then from house 2 it's 3,50,000, and from house 3 it's 3,30,000. Then we are able to obtain the total income from house property, that is 16,85,000. Further, let us have a look to another question. This is actually useful for you, because such questions will be coming in your exam, so you may practice such more questions. Let me help you with this numerical. Mr. Lal is the owner of a house property. Its municipal valuation is rupees 80,000. It has been let out for rupees 1,20,000 per annum. The local taxes which are payable by the owner amount to rupees 16 lakh, but as per agreement between the tenant and the landlord, the tenant has paid the amount directly to the municipality. The landlord, however, bears these following expenses on the tenant's amenities: extension of water connection, water charges, lift maintenance, salary of gardener, lighting of stairs, maintenance of swimming pool. The landlord claims these reductions. Repairs have been paid by tenant. Then land revenue paid by tenant, insurance premium paid by owner, interest on borrowed capital for the payment of municipal tax of house property, that is 1,000 rupees. So from this all information we need to compute the taxable income from the house property for the assessment year 14-15. Means previous year 13-14 is to be taxed in this question. To begin with, we will compute the income from house property using the gross annual value. To be higher of these, either the municipal value, which is 80,000, or the de facto rent, which is 1,20,000 minus the amenities. And the rent received in this case is 1,20,000. The amenities are water charges, lift maintenance, salary of gardener, lighting of stairs, maintenance of swimming pool. These 5 amenities are provided, and which are amounting to rupees 6,750 in total. So we can subtract it. So in that case, your gross value is considered, annual value is considered as 1,13,250. We can subtract the local taxes, that is rupees 16,000 from it, and no reduction is permissible as the taxes have been paid by the tenant, because it is taxable. We cannot have the deduction. We can have the deduction only when it is being paid by the landlord himself. So in that case, your net annual value comes out to be as 1,13,250, and from this we can provide the standard deduction of 30% of NAV. So we can calculate 30% of it, and we can subtract from it in order to obtain the income from house property. Thank you. You may practice more of the questions. If you face any problem while calculating such solutions to the questions, you may contact me. Thank you. Take care.